All right, guys, I got Paul Vincent is with us today. He is an attorney. He's going to talk about raising capital legally, what you can do, what you can't do. You can do it for real estate. You can do it for buying a business and no such things.
Like Kevin mentioned, a lot of people think it would be different if you're raising money for a business than like a commercial real estate deal, but it's really not as far as the capital raising goes. The long and short of it is you're raising capital from others because you can't otherwise afford it yourself. But, kind of the legal definition of it's a group of individuals or legal entities pooling resources for a common goal. That common goal is acquiring whatever it is that you want to acquire. Lots of folks do syndications. They just knowingly or unknowingly just didn't do the proper paperwork to protect themselves and their investors. Security is basically just you want to provide an idea to an investor based on your business plan that they give you money for and that they're going to expect a return on that investment. If someone ever gives you money and they're expecting a profit on that money, then you're dealing in securities. If you're wondering like, hey, how should I put something under contract? I always recommend if you're marketing for deals that you have a marketing LLC or some other LLC that's putting stuff under contract. Those active members are usually people that either found the deal and are quarterbacking the deal and then the teammates of that partner. So people that are going to actually be doing work to get that deal under contract and then get it to succeed. If somebody brought me on as a loan sponsor to run a gutter company, they would laugh me out of the room because I know nothing about installing gutters. Okay, if it's confusing, you're losing. Don't make it complicated. Our preferred return is just, hey, after the expenses of the company, we have this profit at the end of the quarter or the end of the month or however you want to pay it to your investing members. Those investing members get their return first before anybody else gets a distribution. So they're a priority. If an investor gave you $100,000, they're going to get $2,500 every quarter. Sometimes you can have waterfalls, which is you have a targeted return to your investors. And then once you hit a targeted return, maybe you flip distributions to go a little bit more so to the GPs instead of the LPs. You don't want to overpromise and underperform because that's a tough way to sell your deal. The way you're able to raise money is based on Securities and Exchange Commission allowing you to do it under these two exemptions. These are the two most common for people that want to raise money from others. All the necessary paperwork of Facebook goes public to raise money, all these IPOs that you might see out there that people have to do. Those kind of capital raises are tens and tens of millions of dollars to do to get on the stock exchange. If you're raising capital to buy a business, you're really only raising that at the outset and you don't have to worry about it. So if you want to raise from non-accredited investors, less wealthy investors, you want to use 506B. And I got a slide to help with that here. 506Bs for buds and blood, people you have a pre-existing relationship with. If you don't have many friends and family that you think would invest in your deal, then you're going to want to go to 506C, which means that you can take investments from the crowd. The only catch on marketing to the crowd is they have to be accredited only.
I knew some of these were never going to pay it anyway. I don't know why they didn't know it.
I would stress the importance of most people aren't investing in the thing. They're investing in the person more so than the business plan. And no matter how good you think your deal is, 99 out of 100 don't really care that much. They're not going to be as excited about it as you are.
If you can't give it to them in 35, 40 seconds, it's too long. It's too complicated. We could talk about the strategies on that. Like what Mario was saying about digging that well before you're thirsty. That's the key to it. You'd be shocked how much money is out there to invest in good opportunities. You just got to do it the right way. I have a friend who raises money. He's like, I only raise money from rich people, like people who are multimillionaires. And I think that's a better way to do it. That doesn't mean you shouldn't have every intention to fight to get their money back.
Problem with me is I would not be able to put my head on the pillow at night if somebody lost money with something that I was responsible for.
If you're raising money to acquire something that's spitting out cash, that's good. If you're like, hey, I got MCA loans and I'm paying 30% and I want to get this at 15%, so I cut that, to me, that's a recipe for disaster.